Thanks for joining us at this Magellan update. Today I'm speaking with Hamish Douglass, the co-founder of Magellan and more importantly the lead portfolio manager on our global equity strategy. Hamish, we've experienced one of history's longest bull runs. Do you think people are starting to become more immune towards capital preservation?
Well, Frank, it has to be natural, isn't it? We've just anniversaried the 8th year of this bull market, which happens to be the second longest bull market in history. And if you looked at the bond markets, we've just been through the longest bull market in history, measured in decades. When asset prices keep going up in price, I think it's easy for people to become complacent and lose some of the history and some of the important lessons we take out of periods where you get substantially down market periods of capital destruction that's going on. So I think it's just natural, and then we see behaviour. People start reaching for yield as bond markets keep going down, and I think they start reaching for what I would call relative returns. Or something's doing slightly better somewhere else, or the index is doing something. We hear a lot on this relative returns, but not really focused on the risk, the unit of risk people are running to get those returns. We're very, very focused on the risk we're wearing and whether we're running capital preservation risks.
Why is capital preservation important and how do you think about it?
Well, when markets go down very substantially, when you get a big correction in markets, the problem when markets go down, it's asymmetrical. And what I mean by that, if markets were to fall 50%, you need to double from there to get back to where you started from. So it's asymmetrical in percentage terms. So if you go down substantially less than the market, you have to make a lot less on the way up in order to get back to the high point. So that's a very important point. The second important point in terms of capital preservation is when markets dislocate, that's often one of the greatest opportunities to buy assets that are materially mispriced. But if you don't have some form of advantage at that point of view, that you've got capital preservation, which means you'll have more purchasing power, you just can't take advantage of that point of dislocation. How we think about this is we're thinking about this in terms of our down market performance in adverse market conditions. So what we do is we measure every quarter. Is that quarter a quarter where the markets have gone down? If we took over the last 3, 5 or 7 years, we have outperformed every single quarter where the markets have gone down, and we've had substantially lower downside capture risk. It's the percentage our strategy's gone down relative to the markets. In the last 3 years, we've captured only 30% of the downside. Over 7 years, we've captured 24% of the downside, which gives us a substantial advantage. You don't see it all during a bull market, of course, but if we get a major correction, how we think about capital preservation is the advantage we capture versus the markets. And I think our track record and the risk we run in the strategy is materially lower risk than your standard market indices.
Hamish, there's lots of companies investing in artificial intelligence, Google, Amazon, etc. Can they all be winners, and what happens to the potential losers?
Well, first of all, of course, not all companies can be winners in what's going on in artificial intelligence. You've mentioned a very interesting list of companies. I think you mentioned Google and Amazon and Apple. Facebook, I think we could talk about in that list of companies. First of all, many of those companies aren't directly competing against each other in what they're doing. And the forms of artificial intelligence, which is really known as artificial general intelligence. So it may be image-based search to understand that. It may be a ranking system for Amazon to know your previous searches on Amazon to show you goods on your Amazon page that are relevant. Google giving you very relevant searches are all using forms of artificial intelligence. And where artificial intelligence is up is effectively advancing the individual competitive advantages of each of those businesses. And that's perfecting artificial general intelligence. And that's probably available to all those companies. In the longer term, there is something that is called artificial general intelligence as opposed to this narrow intelligence, which is really computer systems that can be as or more intelligent at the capability of human beings across sort of any task, including being able to think and understand natural languages, which of course computers can't do at the moment. But if one of these companies was to really crack AGI or general intelligence as it's known, they could have substantial advantages versus virtually any company in the world. I think we're probably 20 years away from a company really cracking that equation. It could be sooner, but in terms of these companies you're talking about, I think for the next 20 years, all of these companies, because they really don't compete against, one's a social network, one's an e-commerce player, one's a deep search engine, another platform is of course Apple. I think these companies are going to continue to grow, and AI is going to continue to advance their cases versus many other companies in the world.
Hamish, share markets are at record highs since the Trump election. What do you think the risks are for markets in 2017?
Well, that's a very specific question. I think we can identify a number of risks. Placing the probabilities on those risks are somewhat difficult. If we started in Asia Pacific, I think there are two risks out there. One is the stability of the renminbi. It appears that China has more control over the renminbi at the moment and capital repatriation, but should they start to lose that battle, that would obviously be a risk for economic developments in the world. A second risk in Asia, I think, is really what's going on in North Korea. If North Korea dramatically advanced their nuclear capability to an intercontinental ballistic capability within 2017, and then demonstrated in some form that they could use that and were ahead of the curve of China and the United States being effectively able to stop that capability, I think that could change the psychology quite materially. So that's a risk out there. If we turn to Europe at the moment, maybe we could have another Grexit in the middle of the year. We've just had the Dutch elections, but they've gone the way of stability, which is good news. But the crucial thing coming up in Europe is in May is the French elections. The next thing I'd put on the agenda would be global monetary policy. And it's really the US Federal Reserve. People are expecting a sort of very steady rate increase at the moment, and that's being priced in by markets and being signalled by the US Federal Reserve. But should the US economy pick up a greater head of steam, or something out of the Trump policies come in and people getting pretty bullish on the expectations, the Fed could turn decidedly more hawkish at the tail end of this year, and that could actually create quite a lot of instability in markets in terms of what isn't yet priced into bond markets and equities of a more rapid increase in interest rates. I'm not saying that's going to happen, but I think that's a fundamental risk. And the last one obviously is what's going on with Trump at the moment and the policies. I think the risks for the world for Trump are really around how he's going to handle the resetting of the relationship with China, and does he make a major mistake? These are the two largest economies in the world with a very important economic relationship, and of course enacting sort of more protectionist trade policies. Are we going to enter in a period that looks like we're going to get in a trading war? So those are probably the big issues for 2017. All of them got different probabilities. So let's see what happens.
Hamish, Trump plans to cut taxes, shred regulations, invest in infrastructure. Are the economic policies likely to be good for the US, and how are you positioning the portfolio?
Look, overall, we're cautiously optimistic on let's call it the Trump Republican policies, because the policies actually have to get through the Republican Party, who's in control of Congress, both houses. They're in control of from a budgetary sense. Is having lower taxation and reforming the taxation code positive for business? Yes, it is positive for business. What we have to see is how is it going to be paid for? Is reducing regulation, particularly unnecessary regulation that may be stopping the economy and making it more bureaucratic, would that be positive for business? Yes, it would. Infrastructure, I'm more sceptical on. I think infrastructure is a very long-term direction. Is it good for the long-term productivity of the United States, investing in critical infrastructure and making the economy work more efficiently? Yes, it is. But is it going to have a material impact in the next few years? I think it's very unlikely to have a material impact in any economic sense in the short term. So what does the backdrop of those policies of taxation reform, lower corporate taxation, maybe personal taxation reform, repatriation tax reform, maybe a border tax, which I'm not that optimistic on in terms of its consequences. But what economically does this mean? It probably means higher US corporate profitability. It probably means a better business investment environment in the United States. I think we're already hearing from the US Federal Reserve increasing interest rates. I think we're going to get higher interest rates, and with that backdrop, I think we're likely to get a strong US dollar. So how are we positioned with all of that? We have about 70% of the portfolio in US domiciled companies, many of these multinationals, and when you look through it, we have about 55% of the company's earnings in US dollars. So we should benefit from lower taxation and reduction of regulation, a better business environment, because we've got companies domiciled in the United States, and over half our earnings are coming in US dollars out of the United States. In terms of interest rates, we're kind of fairly neutral on the interest rate story. We're sitting in 15% cash, and as rates go up, we think we're going to find some more value to redeploy that assets, particularly in what you would call the bond proxy type equities, which react to particularly longer term interest rates going up. So as that plays itself out, we think we'll get an opportunity. Where I'd say we're probably underweight would be US financials. Their prices have run very, very materially, almost immediately after the election of President Trump. But we're not going to chase the ambulance. That's pretty much reflected in their share prices today. The caution I would have around Trump would be a few areas, probably on healthcare policy is something we're watching in our portfolio very carefully. We're at slightly over 10% of the portfolio in healthcare stocks, not all of it directly attributable to the United States. Some healthcare reform may not be always positive for healthcare companies, but let's see the water go under that bridge. We're thinking about that. And in terms of China, how he's going to reset this relationship for China, which I think is one of the big risks economically in the world. We've got about 5% of our portfolio directly exposed to China, which is very, very modest. So I'm not concerned about that, but obviously we're watching it, and we could even reduce it somewhat until we get greater clarity around the US-China relationship moving forward.
Thanks, Hamish.
Thank you, Frank.
And thanks for watching. Feel free to forward this link on to colleagues or clients that you think might be interested, and you can find out more information on our website. Thanks.